Welcome to all the viewers of our channel. This is a presentation from our academy, GVS Bank Academy. I am GV Subbarao, qualified cost accountant, company secretary, and semi-qualified chartered accountant, and I am a retired banker as AGM. Today, I am going to present the leverage ratio topic for the benefit of JAB, CAB, and the bank's promotional exams and bank's interview also. This topic is very important. And for the CAB, they are asking sometimes 5 marks case study. And in all the promotional exams also, 1 or 2 marks they are asking. So this is very important and useful topic for all these exams. So the leverage ratio is one of the major amendments in Basel III. Leverage ratio is one of the major amendments introduced in Basel III, and it was implemented in India with effect from 1st April 2015. This was introduced with effect from 1st April 2015. Now, what is meant by leverage ratio? Leverage ratio. Under Basel III, a simple, transparent, or non-risk based leverage ratio. So, Basel 2 and 3 talks about the risk-weighted assets. Under Basel III, along with the risk-weighted assets, CRAR, capital to risk-weighted assets ratio, they had introduced the leverage ratio. Under leverage ratio, the non-risk based, for the purpose of calculation of leverage ratio, we are not calculating the risk-weighted assets. That is the non-risk based leverage ratio. This is the major advantage in this. The leverage ratio is calibrated to act as a supplementary measure. So this is just supplementary additional to CRAR. The leverage ratio is a supplementary additional tool for CRAR, capital to risk weighted assets ratio, to the risk based capital requirement. It is a supplementary tool for the risk based capital requirements intended to achieve the following objectives in the banking industry. Constrain, build up excessive leverage in the banking sector. So it is going to stop the excess leverage by the banks in the advances and strengthen the risk-based requirement. It is going to strengthen the risk-based requirement with a simple non-risk-based. So leverage ratio means non-risk-based assets we are taking, number 2. Number 3, it is a backstop measure. So CRAR, capital to risk-weighted assets ratio, is a from front-ended, and leverage ratio is a back-ended tool to manage the risk of leverage or excess buildup of leverage in the banking books. So CRAR from the front-ended, and the leverage ratio is going to stop the excess leverage from the backstop measure. So this is the about the leverage ratio. Definition and minimum requirement for the leverage ratio. The Basel III leverage ratio is defined as the capital measure. So capital, this is the numerator. What is the numerator in the leverage ratio? Capital divided by the exposure. Capital divided by exposure measure. This is the denominator. So in the examination they are asking the leverage ratio. What is the numerator? Capital. What is the denominator? That is exposure method. It is going to express it in percentage. So leverage ratio formula is capital measure divided by exposure measure. Implementation of leverage ratio in Indian banking industry. Presently, the minimum leverage ratio shall be 4% for domestic systemically important banks and 3.5% for other banks with effect from 1st October 2019. So, for the big banks, that is 4%, remaining all other banks, that is 3.5% for other banks. What are the domestic systemically important banks? As of date, domestic systemically important banks, DSIBS, are SBI, ICICI Bank, and HDFC Bank as of today. For these 3 banks, leverage ratio is 4%. Remaining all other banks, that is 3.5%. So this is about the definition and minimum requirement of leverage ratio. Leverage ratio definition, capital measured by exposure method. Now we are going to see what is meant by capital and what is meant by exposure. Capital measure for the leverage ratio purpose is Tier 1 capital. For the calculation of leverage purpose, ratio purpose, we are taking only Tier 1 capital. What is meant by Tier 1 capital? Common equity Tier 1 capital, that is CET1. Common equity Tier 1 capital plus additional Tier 1 capital, both comes under part of Tier 1 capital. So, the capital measure is equal to Tier 1 capital total you have to take. That is common equity Tier 1 capital plus additional Tier 1 capital total is the numerator for this leverage first. What is the common equity Tier 1 capital? Elements are instruments. Paid up capital of the bank, share premium outstanding in the bank books, statutory reserves are also outstanding in the bank's books, capital reserves in the bank, and any other disclosed free reserves are also part of Tier 1 capital. Balance in profit and loss account at the end of previous financial year also comes under Tier 1 capital. Revaluation reserve. Fixed assets revaluation reserve also part of Tier 1 capital, but at a discount value of 55%. It means that fixed assets revaluation reserve you can club to Tier 1 capital with a 45% value. That is revaluation reserves. And foreign currency translation reserve at a discount of 25%. Means any bank is having a foreign currency translation reserve outstanding in its bank books. That out of that amount, 75% we can add to Tier 1 capital. This is the element of common equity Tier 1 capital. And what are the elements of additional Tier 1 capital? Additional Tier 1 capital instruments as of today, this is accepted by RBI, that is perpetual non-cumulative preference shares. Perpetual non-cumulative preference shares. As for Reserve Bank of India Basel III compliance, common equity Tier 1 capital requirement for Indian banks as of today is 5.5% of risk-weighted assets, and additional Tier 1 is 1.5% of risk-weighted assets. Total Tier 1 capital requirement, minimum requirement is 7% as of date by RBI stipulations. This is about the capital measure, that is part of leverage ratio numerator. Now we are going to exposure measure, denominator part of the leverage ratio. A bank's total exposure measure is the sum of the following exposures. Total exposure measure is the sum of the following. This is very important. On balance sheet total exposures. From the bank's balance sheet, on balance sheet, you have to take the outstanding balance sheet, on balance sheet figures for the calculation of leverage ratio total exposure. Number one. Number two, derivative exposures. All the outstanding derivative exposures you have to calculate with the replacement cost with the association with all the derivative transactions. Present outstanding derivatives you have to calculate with the present replacement cost. And with that, any cash margin is there, replacement cost minus eligible cash margin you have to deduct. Then you will get the derivative exposure for total exposure measure you will take. Number three, securities financing transaction exposures. Any securities financing transaction exposures which are repo, repurchase obligations, reverse repo, obligation, lending operations, and margin lending of transactions. All are the part of securities financing transactions. Any outstanding positions are there under repo, reverse repo, and margin lending transactions are there. That exposure also you have to take into part of total exposure measure. The last one is off-balance sheet items. Off-balance sheet items. These off-balance sheet items have to first convert to on-balance sheet after conversion to credit equivalent amounts. From off-balance sheet to on-balance sheet, how you are going to convert this? By applying credit conversion factors of the standardized approach for credit risk. As of today, for credit risk, we are following standardized approach. As for that standardized approach, for the off-balance sheet items, RBI has given some credit conversion factors for each and every off balance sheet non-fund based limits. Accordingly, you have to apply that credit conversion factor, then convert the off balance sheet to on balance sheet exposure. This is the total exposure measure: on balance sheet exposure, derivatives exposure, securities financing transactions, and off balance sheet items. For example, one small example: outstanding credit facilities in a borrowing account, fund based and non-fund based credit facilities outstanding as on 31st March 2020. How we are going to take into exposure measure that we are discussing? Cash credit account 200 crores outstanding, financial guarantee 100 crores, performance guarantee also 100 crores, documentary letter of credit 100 crores. In a borrowing account, these are the outstanding portions as on 31st March 2020. For the exposure purpose, how we are going to take the items? Cash credit outstanding, that is the exposure amount, as it is we can take. Financial guarantee 100 crores, that is a non-fund based limit. With the applicable credit conversion factor is, as per standardized approach, 100%. 100 crores into 100%, that is 100 crores is the financial guarantee, which we can add from non-fund based to fund based exposure. Performance guarantee outstanding is 100 crores. Credit conversion factor is 50%. So 100 crores into 50%, 50 crores we can add from non-fund based exposure to fund based exposure. And documentary letter of credit, outstanding portion is 100 crores. Credit conversion factor as per RBI CCF norms, 20%. 100 crores into 20%, 20 crores is the from fund based to non-fund based to fund based. So now the total assets which are eligible for the leverage purpose under the exposure, current exposure norms. That is cash credit 200 crores, financial guarantee 100 crores, performance guarantee 50 crores, and documentary LC 200 crores. For the exposure purpose, from this account, we are taking for the leverage purposes 370 crores. From this account, for the exposure purpose, we are taking 370 crores for the leverage calculation. So, bank as a whole, in this manner, we have to calculate the from non-fund based facilities to fund based facilities for exposure calculation. Now, a small example, bank as a case study. Details of a bank as on 31st March 2020 in the consolidated position as follows. This is the outstanding position of the bank as on 31st March 2020. Tier 1 capital of the bank. Tier 1 capital means common equity Tier 1 capital plus additional Tier 1 capital of the bank as on 31st March 2020 is 24 lakhs 59,959.02 crores. This is the Tier 1 capital measure this is. Then total exposure is the bank is 4 crores 41 lakhs 67,049.95 crores is the total exposure of fund based and non-fund based. Fund based from the balance sheet, non-fund based assets. By applying credit conversion factors, we are converting from non-fund based to fund based without risk weights. In the fund based advances, we are not applying risk weighted assets. In non-fund based advances also, we are not applying any risk weights. So the total exposure is 4 crores 41 lakhs 67,000 49.95 crores. What is the leverage ratio as per Basel III in percentage? Capital, Tier 1 capital is equal to 24 lakhs 59,959.02 divided by 4 crores 41 lakhs 67,049.95 crores into 100. The leverage ratio is 5.57%. The leverage ratio as on 31st/3/2020 of the bank is 5.57. So, what is the difference between capital to risk weighted assets ratio and leverage ratio? For the purpose of calculation of capital to risk weighted assets ratio or CRAR ratio, we are taking Tier 1 capital plus Tier 2 capital. That is the numerator. For the denominator, we are taking the risk-weighted assets for credit risk, market risk, and operation risk total into 100. That is the CRAR purpose. For the leverage purpose, for the leverage ratio calculation purpose, only we are taking Tier 1 capital. That is common equity Tier 1 capital plus additional Tier 1 capital. That is 1. Then for the denominator purpose, we are taking the exposure, only exposure, fund-based exposure from the bank's balance sheet plus non-fund-based exposure, which are converted to fund-based by applying the credit conversion factors and without risk weights. Fund-based and non-fund-based advances, we are not taking any risk-weighted weights. So leverage ratio is a, you can conclude that leverage ratio is a fund-based or non-fund-based without risk-weighted assets. This is a non-risk-weighted assets calculation, whereas CRAR is only risk-weighted assets calculation. That's why CRAR is the front-end calculation, leverage ratio is the back-end calculation. From one side, through CRAR, RBI is monitoring against the banks, number one. Number two, through leverage ratio also, bank is monitoring, RBI is monitoring the bank's exposure with its Tier 1 capital. So both are the monitoring tools by RBI and both are introduced, both leverage ratio was introduced under Basel III as major amendment. This is about the leverage ratio. And disclosure requirements of the leverage ratio by banks. Banks are required to disclose their Basel III leverage ratio on a consolidated basis of the bank with effect from 1st April 2015 as per RBI stipulation that is there. Banks must disclose the following three items on a quarterly basis in the balance sheet, whether it is a audited or unaudited, irrespective of whether financial statements are audited or unaudited. Banks have to disclose what is the Tier 1 capital. Tier 1 means common equity Tier 1 capital plus additional Tier 1 capital. Total exposure means total fund-based exposure and total non-fund-based exposure by converting into fund-based by applying credit factors without risk-weighted assets. That is total exposure. And finally, leverage ratio is. What is the leverage ratio? Finally, the leverage ratio for Indian banks, for SBI, ICICI and HDFC Bank is 4%. For other bank that is 3.5. So this is about the leverage ratio, which is very important for Jaiib, principle and practice of banking, and CIB, risk management, part of Basel II, Basel III, and preparation for promotional examinations for all scales and for interviews for all scales also. Thank you very much for the viewers. Please subscribe our YouTube channel for watching our forthcoming updations for JIB, CAB and promotional exam videos. Thank you very much for watching our YouTube channel.